In this section of the course, we will be discussing why investing in gold is a good idea. Gold has a 5,000-year history as a stable form of money, often considered the perfect currency. Its appeal lies in its intrinsic value and scarcity. Unlike fiat currencies which can be printed at will, the supply of gold is limited and grows at a slow, predictable rate. This limited supply, coupled with high demand, ensures that gold remains a valuable asset, particularly during economic crises. Gold's scarcity and durability make it an ideal store of value. Now, some critics argue that gold is a useless material or useless asset because it doesn't generate dividends or interest, and it's primarily used for jewelry. However, it is precisely this characteristic that makes gold such a great form of stable money. Its lack of extensive commercial application and its high cost of extraction ensures that gold remains scarce and valuable. Gold fulfills the 10 characteristics of good money more effectively than most alternatives, including Bitcoin. These characteristics are: durability. Gold does not corrode or degrade over time, ensuring its longevity. Then portability. While not as portable as digital currencies, gold's high value to weight ratio makes it relatively easy to transport. Divisibility. Gold can be melted and divided into smaller units without losing value. Uniformity. Each unit of gold is consistent and indistinguishable from another, ensuring uniformity. Limited supply. Gold's supply is finite and cannot be increased at will, preserving its value. Acceptability. Gold is widely accepted and recognized globally as a valuable asset. Stability of value. Gold has historically maintained its value over long periods of time. Recognizability. Gold is easily recognizable and distinguishable from other metals. Fungibility. Each unit of gold is interchangeable with another of the same weight and purity. And then lastly, resilience. Gold is resilient to various economic, political, and technological disruptions. Now, while Bitcoin has been touted as digital gold and shares several characteristics with gold, such as limited supply and portability, it falls short in other areas. Bitcoin's volatility, regulatory uncertainties, and reliance on technology make it less stable and reliable as a long-term store of value. Furthermore, Bitcoin is not as universally adopted and there are significant concentration risks due to whales, that is, a small number of holders controlling a large portion of the Bitcoin supply. Additionally, central banks worldwide hold significant gold reserves, further reinforcing its status as a hedge against economic instability. Countries like the United States, Germany, and China have substantial gold reserves, which act as a buffer against currency fluctuations and economic downturns. Central banks are buying gold, not cryptocurrencies, highlighting the enduring trust in gold as a stable asset. While Bitcoin represents a noble idea and blockchain technology is likely here to stay, the existing financial powers are unlikely to entertain new forms of money that threaten their monopoly. Gold, often referred to as God's money, continues to hold intrinsic value that is recognized and respected globally. As someone from an emerging market, I'm very familiar with the effects of inflation and high interest on existing debt obligations. Inflation can deflate the real value of debt over time. For instance, when my mother bought a house in 1996 for 100,000 Rand, we sold it a decade later for over 1 million Rand. The increase was not due to the property becoming more valuable, but because the currency had devalued. Inflation, in effect, deflates debt away. However, it is important to note that during currency resets, debts may be remonetized into the new currency values. This means that while inflation may reduce the weight of the debt itself might be recalibrated into the new currency, nullifying the deflation effect. For example, in Zambia, the currency was remonetized, turning 1,000 kwachas into 1 kwacha, but the debt would also adjust accordingly. And this is where gold comes into play. When the value of gold increases, it can be sold to settle debts, providing a strategic advantage. In later sections, we'll discuss how to strategically allocate and use your gold investments effectively, rather than merely hoarding for the sake of it. In the next session, we will look at gold as a hedge.